Welcome to the deep dive. Today we're tearing into the full year and fourth quarter 2025 financial results for the PNC Financial Services Group. They just dropped on January 16th, 2026. Our mission here is to slice through the spreadsheets, pull out the major achievements that drove what was a record year. And we also need to understand the mechanics behind that success and, maybe most importantly, identify the critical watch areas. Because what we found is a narrative of, aggressive expansion and some serious capital return, but it's set against a backdrop of rising credit strain.
That tension really is the core story here, isn't it? The headlines are undeniably positive. It signals a really successful strategic push.
Absolutely.
So PNC reported record revenue for full year 2025, topping out at $23.1 billion.
$23.1 billion.
Yeah. And full year net income hit $7.0 billion. That translates to $16.59 in diluted earnings per share.
And the CEO...
Right. The CEO said it was a result of strong execution across all business lines, which, led to that really impressive 21% year-over-year earnings per share growth.
21% EPS growth. I mean, that's not just good. It's market-leading performance in the current banking landscape.
It really is.
So let's quickly frame that full-year picture before we get into the weeds of Q4. Looking at the key metrics compared to 2024, the uplift is pretty much uniform and substantial.
Absolutely. The top-line revenue figure, it climbed from about $21.5 billion in 2024 to just under $23.1 billion in 2025.
Okay.
And this drove net income up significantly from roughly $5.9 billion to almost $7 billion.
Wow.
So that $13.74 diluted EPS figure in 2024, it jumped sharply to $16.59. When a bank sees that kind of holistic improvement, you have to look for operational efficiency. It's not just market luck.
And that, I think, leads us directly to this concept of operating leverage. How did PNC manage its internal mechanics to get to that $16.59 result?
Well, they achieved 5% positive operating leverage for the full year.
And what does that mean exactly for someone listening?
What that means is they managed to grow their revenue 5% faster than the cost required to, generate that revenue.
Right.
In a high inflation environment where a lot of companies are struggling just to keep expense growth flat, achieving 5% positive leverage is... well, it's a testament to really disciplined cost management combined with genuine business expansion.
So more of every new dollar earned is translating directly into profit.
Exactly.
That focus on efficiency is key. But PNC wasn't just managing the books in 2025. They were also planning aggressively for 2026. And that brings us to the big strategic move they executed right at the start of the new year.
The acquisition of FirstBank Holding Company.
A massive scale play.
It really is. The acquisition closed on January 5th, 2026. And this isn't just some minor regional shuffle. FirstBank immediately added $26 billion of assets, $16 billion of loans, and $23 billion of deposits to PNC's balance sheet.
So it's significantly transforming the regional footprint and scale.
Oh, absolutely.
And just to ground the discussion for you, while that deal is colossal, since it closed in January 2026, those results aren't reflected in the Q4 2025 report we're talking about right now.
Right, that's an important clarification.
But they will be the major strategic variable impacting the first quarter of 2026. So that gives us great context for the future. But let's dive back into Q4 2025, which saw that record-breaking revenue of $6.1 billion. That's up 3% quarter over quarter. We need to unpack the two engines driving that: net interest income, or NII, and non-interest income, often called fee income.
Okay, starting with NII. This is the heart of banking profit, right? The difference between what they earn on loans and what they pay on deposits.
The core business.
The core business. NII increased 2% sequentially to $3.731 billion. And what's even more telling is the net interest margin, or ENIM. That actually increased 5 basis points to 2.84%.
A 5 basis point expansion in IM in this environment is a powerful competitive signal. We know most banks are fighting tooth and nail against rising deposit costs. So what specifically allowed PNC to expand its margin when so many of its peers are seeing theirs compress?
That's the real takeaway here. It's competitive advantage through what seems to be superior liability management. The drivers they cited were a combination of loan growth, the benefit of fixed-rate asset repricing, and crucially lower funding costs.
Lower funding costs.
Yes. In this high-rate environment, where aggressive deposit competition is just the norm, the ability to actually lower their blended cost of funds suggests a sticky and loyal deposit base.
Okay, so that's financial engineering at its best. Now let's pivot to the other side, the fee income. That was equally strong. It also grew 3% quarter over quarter, hitting $2.123 billion. Where did the biggest lift come from?
This was driven by the investment banking and advisory side of the house. The capital markets and advisory fee segment saw a significant 13% quarter-over-quarter increase in revenue.
13%.
And they attributed this almost entirely to higher merger and acquisition advisory activity. So while the interest margin improved due to efficiency, the fee income was just turbocharged by corporate deal-making.
Interesting. Let's set aside the big success numbers for a second and look at a specific line item that kind of highlights some underlying complexity.
Okay.
Buried in the notes, we find other non-interest income of $217 million. And this included a negative $41 million hit from Visa derivative adjustments.
Right, related to litigation escrow funding. And that charge is up from a negative $35 million impact in Q3.
So it's small, but it shows a persistent non-operational headwind.
Exactly. This relates to, long-standing legal funding escrow concerning Visa. It's not core business performance, but it's a recurring historical drag that just keeps ticking up.
Okay, moving to expenses. Non-interest expense increased 4% quarter over quarter to $3.6 billion. The bank says this is due to increased business activity and seasonality. But, while they achieved positive operating leverage for the full year, seeing expenses rise faster than revenue in the quarter 4% expense growth versus 3% revenue growth, that suggests Q4 operational efficiency faced some pressure.
Yeah, that internal pressure is likely seasonal, but it's something to monitor. However, the biggest sort of non-operational tailwind for Q4 was the tax rate.
Tell us about that surprise tax drop.
It provided a massive non-recurring boost. The effective tax rate dropped dramatically to just 12.7% in Q4.
Down from what?
Down sharply from 20.3% in Q3. The source explicitly stated this was due to the favorable resolution of several tax matters.
So they settled some old disputes.
Essentially, yes. They settled some lingering tax issues with regulators, which let them book a sudden, large tax benefit. It's great for Q4's reported net income, but you have to remember this isn't sustainable.
Right. The tax rate will inevitably snap back to normal levels next quarter.
Exactly. It made the quarter look a bit better than the core operations alone might suggest.
That perfectly sets the stage for shifting focus to the foundation of the bank, the balance sheet. Let's see how the core business elements, loans, and deposits performed.
Okay. So average loans increased 1%, or about $2.0 billion quarter over quarter. And this is where we start seeing the threads connect.
How so?
That growth was driven almost entirely by the commercial and industrial, or C&I, portfolio. This tells us corporate lending is driving both the revenue and the balance sheet growth.
And the consumer side, was that just treading water?
Well, average consumer loans were stable, but that masked a balancing act. They saw growth in higher-yielding auto and credit card portfolios, but those gains were exactly offset by continued declines in residential real estate loans.
Got it. Now, what about deposits, the money that funds all this?
The deposit base saw a strong 2% growth, adding $7.7 billion quarter over quarter, and that was driven by growth in both commercial and consumer accounts.
That commercial deposit growth is a good indicator of sticky, core corporate relationships. And on the funding side, I saw they're moving away from more expensive market sources.
Yes, and that's a key efficiency signal. They reduced brokered time deposits by 26% quarter over quarter.
26%.
Yeah. By relying less on that wholesale market-sourced funding, they're reinforcing that narrative of lower funding costs that drove the increase. It speaks volumes about their liability management.
Okay, before we hit the critical watch area credit quality, let's quickly look at capital. Tangible book value, TBV, is the key indicator of core capital strength, and that increased a healthy 4% quarter over quarter to $112.51 per share.
And their capital return plan really reflects that confidence. PNC returned $1.1 billion to shareholders in Q4. That was split between $0.7 billion in common dividends and $0.4 billion in share repurchases.
And what's the forward-looking signal?
Here it is. They're explicitly guiding for share repurchases to increase significantly in Q1 2026. They're targeting approximately $600 to $700 million.
That's an aggressive signal of confidence, especially right after they just onboarded $26 billion in assets from FirstBank.
It's very aggressive.
Okay, now for the watch areas. We need to spend some time here because this is where the risk component of the story really shows up. On the surface, the immediate bad news, the charge-offs look controlled.
Right. Net loan charge-offs actually decreased quarter over quarter and year over year to $162 million.
So that's the good news.
That's the good news. But charge-offs are a lagging indicator. They tell you about loans that have already gone bad. The forward-looking indicator, delinquencies, is flashing orange.
Oh.
Total delinquencies. So loans 30 days or more past due. They increased a startling 17% quarter over quarter.
17%.
Yeah, that's a jump of $210 million,
Yeah.
taking total delinquencies up to $1.4 billion.
Mhm.
And the stress was broad-based, affecting both commercial and consumer loans.
And if we connect this delinquency jump to the next level of stress, non-performing loans, these are the seriously problematic assets.
Yep.
We see another concerning trend there, too.
We do. Total non-performing loans increased 4% to $2.2 billion. And if you look inside that number, the increase was driven specifically by higher commercial and industrial non-performing loans.
So there's the tension point.
This is the crucial tension point. The C&I portfolio drove most of the loan growth for the quarter, but it's also driving the largest increase in non-performing assets.
So wait, if the C&I portfolio is driving loan growth, but it's simultaneously driving the jump in non-performing assets, isn't that a classic warning sign of, growth at all costs?
That is the $2.2 billion question, isn't it? If this is just the natural rise in defaults that accompanies strong growth, then it's tolerable. But if the rate of increase in delinquencies continues to outpace the rate of loan growth, then management will have to pull back the reins.
It signals potential borrower fatigue.
Exactly, especially among commercial clients in this higher rate environment. They are currently betting that the good economy will allow them to manage this strain, but it remains the single largest risk factor in their upcoming quarter.
That frames the risk perfectly. Okay, let's break down the segments for Q4 to see which internal departments were delivering and which were feeling the pressure.
Right, so corporate and institutional banking, C&IB, was definitely the primary engine of Q4 earnings growth. Their earnings increased 4% quarter over quarter to $1.514 billion.
And based on what we've said, I assume that was powered by the investment banking fees and that C&I lending volume.
Exactly. Non-interest income in C&IB was particularly strong, up 7%, largely thanks to that surge in M&A advisory. They also benefited from higher net interest income. But we have to note, the non-interest expense in C&IB shot up 13% quarter over quarter.
13% expense growth, that's significant.
It is. The bank contributes it to higher variable compensation, basically bonuses tied to advisory wins. It was the cost of generating those high returns.
So the question is if it's sustainable.
Right. Can they generate enough high-margin fee income quarter after quarter to justify that jump? The segment's balance sheet also reflected this strength, with average deposits in C&IB increasing 6%.
Okay, now contrast that with retail banking. It saw a softer sequential quarter. It almost feels like two different banks.
It does. Retail banking earnings actually decreased 6% quarter over quarter to $1.241 billion. This was driven by two main things: higher non-interest expense and a higher provision for credit losses.
And that provision increase links back to?
It links directly back to the general rise in consumer loan delinquencies we just discussed. It jumped from $126 million in Q3 to $155 million in Q4.
But let's zoom out. While Q4 was soft sequentially, the retail business is clearly improving year over year, right?
Oh, absolutely. Compared to the fourth quarter of 2024, retail earnings increased 15%, driven by higher net interest income. So the strategic investment is paying off over the long term, even if short-term costs created a dip.
Okay, finally, the asset management group. Was that just steady growth?
Pretty much. AMG earnings increased a respectable 3% quarter over quarter to $121 million. The drivers here were typical of a strong market: higher non-interest income linked to higher equity markets and positive net flows. Discretionary client assets under management increased 3% to $234 billion.
Okay, let's try to synthesize all this. So what does this really mean for you, the listener?
I'd say PNC finished 2025 on a record high. It was fueled by strong NII performance, thanks to that superior funding management, and really aggressive fee income, especially from M&A advisory. Capital strength is robust, and they are demonstrating clear confidence by increasing their planned share buybacks.
However, the central takeaway has to be that rising risk profile. We saw the critical watch area in credit quality, specifically that 17% jump in total delinquencies. It signals rising strain in both the commercial and consumer loan books.
Right, and that's an early warning sign that will need very careful management as the FirstBank integration begins.
It's all connected.
It is. And if we connect this to the bigger picture of the balance sheet structure, their funding profile improved substantially. They reduced average borrowed funds by 9% quarter over quarter, lowering those expensive Federal Home Loan Bank advances. They're actively managing liabilities while also repositioning assets.
That is a masterclass in operational detail. Okay, finally, here's the provocative thought we want to leave you with, building on the tension we've discussed today. PNC is aggressively increasing its share repurchase expectation for Q1 2026,
targeting up to $700 million. They are simultaneously integrating the massive $26 billion FirstBank acquisition and navigating that recent 17% jump in total client delinquencies. Considering these three simultaneous high-pressure demands, what is the single most significant challenge PNC will face in Q1 2026? Managing the complexity and cost of the integration, executing that dramatically increased capital return plan, or actively mitigating the rising trend in client delinquencies? Think about that delicate balance between growth, shareholder returns, and just plain old risk control.